House prices across Australia's capital cities are now sitting above $1 million on average. The RBA cash rate is currently 4.10% after several rate rises through early 2026. And APRA has recently tightened lending rules again, making it harder for Australians to borrow large amounts. So the question a lot of people are asking is simple. Based on my income, what can I realistically afford? That is exactly what we are covering in this video. We are going through the numbers, salary by salary, borrowing power, deposit size, and what kind of property may be realistic in 2026. The first thing to understand is that banks are less focused on what property you want and more focused on whether they believe you can comfortably repay the loan. That is what lenders call serviceability. In simple terms, they are testing whether your income can handle the mortgage. At the moment, average variable home loan rates are sitting around 6.6%, but banks do not assess you at 6.6%. Because of APRA rules, they add an extra 3% buffer. So even if your actual mortgage rate is around 6.6%, the bank is testing you as if rates were closer to 9.6%. That can make a big difference to how much you are able to borrow. Then there is another major rule. Since February, APRA has limited how many high debt-to-income loans banks can approve. If your total loan is more than 6 times your annual income, you are generally seen as higher risk. Banks can still approve those loans, but many lenders appear to be more cautious now. That means a lot of borrowers may find banks prefer to keep them below that 6 times income threshold. Let's look at the numbers. Australia's median full-time salary is now around $74,000. The average full-time salary is roughly $104,000, so we will use some of the more common salary levels. If you are earning $75,000 a year on your own, your borrowing capacity may sit around $246,000. If you also have a 20% deposit, that could translate to a property worth around $307,000. At that price point, a house in Sydney or Melbourne is unlikely. A smaller unit in a regional area may be more realistic, or possibly a property in a cheaper capital city like Hobart or Darwin. At $100,000 a year, borrowing power may increase to around $338,000. With a 20% deposit, that could put a property worth about $422,000 within reach. That is still below the price of many houses in major cities, but it may be enough for units in cities like Adelaide, Brisbane, or Perth. If you earn $125,000 a year, your borrowing capacity may rise to around $429,000. With a 20% deposit, you may be looking at a purchase price of roughly $536,000. At this level, there may be more flexibility. A unit in a major city could be possible, or potentially a house in a regional area. But inner city Sydney and Melbourne may still be difficult. This is where the numbers start to shift more noticeably. A couple earning $150,000 combined may be able to borrow around $620,000. With a 20% deposit, that could mean a buying budget of around $775,000. At this level, many capital city units may become more realistic, and houses in Adelaide, Darwin, and Hobart may be more achievable. At $200,000 combined, borrowing power may climb to roughly $827,000. With a 20% deposit, that could put a property value around $1.03 million within reach. This is where houses in Brisbane and Perth may start to become more realistic. You are also getting closer to the median house price in some larger cities. At $250,000 combined income, banks may lend around $1.035 million. With a 20% deposit, that may put total buying power close to $1.29 million. Only at this income level does a typical Sydney house begin to look possible, because Sydney's median house price is now around $1.6 million. That means a household often needs to be in the top 10% of incomes just to afford the middle of the Sydney market. That gap between salaries and house prices is one of the biggest financial issues in Australia right now. This is where a lot of people run into trouble. They assume the maximum amount a bank will lend them is automatically the amount they should spend. But those two numbers are often very different. A more conservative approach could be to keep total housing costs below 30% of gross income. That would include mortgage repayments, rates, insurance, and maintenance. Once housing starts taking up 40% or 50% of income, many households may start to feel mortgage stress. So rather than only asking how much you can borrow, it may help to think about a few other questions. How much are you actually taking home every month after tax? What does around 28% of that number look like? And after covering the mortgage, would there still be room to save or invest? For some people, if the answer is no, that may be a sign the property is stretching the budget too far. Most people focus on the deposit, but there are other costs that can catch buyers out. Stamp duty is one of the biggest. Depending on your state and the value of the property, it can cost anywhere from $20,000 to $40,000. There are concessions for first home buyers in many states. In New South Wales, first home buyers pay no stamp duty on homes up to $800,000. In Victoria, there is a full exemption up to $600,000 and discounts up to $750,000. Queensland also offers stamp duty relief on homes up to $700,000 for first home buyers. Then there is lender's mortgage insurance. If your deposit is below 20%, you will usually need to pay LMI. That can add another $10,000 to $30,000 to the total cost. On top of that, there are conveyancing fees, building inspections, pest reports, and moving costs. For many buyers, these extra costs can add another $5,000 to $8,000 on top. A lot of Australians are waiting for rates to fall or property prices to drop. But waiting can have risks too. Over the last 5 years, Brisbane house prices have jumped more than 85%. Perth values have surged more than 24% in just the last year. Adelaide has climbed close to 79% over 5 years. Even Melbourne, which has been one of the weaker markets, is still up around 8.5% over the last 5 years. A lot of people sat on the sidelines in 2021 expecting prices to crash. Instead, they watched prices rise faster than their savings. Every year they waited, the gap became larger. Trying to perfectly time the property market can be extremely difficult. For many people, a better approach may be focusing less on timing and more on whether the numbers work for their situation over the long term. Most people think they need a 20% deposit to buy a property, and while that is often seen as the ideal scenario, it is not the only option. The First Home Guarantee Scheme allows eligible buyers to purchase with as little as a 5% deposit without paying lenders' mortgage insurance. The government effectively guarantees the remaining amount. Since October 2025, the scheme has expanded. There are now unlimited places available, and the income caps have been removed. That means more first home buyers may now be able to use a 5% deposit to get into the market sooner, and for some people, that may matter. Because property prices have often grown faster than people can save. A lot of people start with the house they want and then try to work backwards. But another way to think about it could be starting with what feels manageable first, then protecting the gap between income and spending, and using that gap to build wealth over time. Because if a mortgage consumes every spare dollar, it may leave very little room to invest, save, or build financial flexibility. Ideally, a house becomes part of building long-term wealth, not something that creates financial pressure every month. One way some people approach this is by taking their annual income, dividing it by 12, then multiplying it by 0.28. That can give a rough idea of what a more manageable monthly mortgage repayment might look like. From there, it may be easier to work backwards and estimate a more realistic property budget. And in many cases, staying within that number may matter more than borrowing the maximum amount a bank is willing to offer. If you enjoyed this video, subscribe to the channel, and I will see you in the next one.